Hello doctor, we are from group B5 and this is all of the group members. For this study, our objective is to estimate the theoretical value of an FBMK-LCI option using the Black-Scholes model. Then we compare the theoretical value with the observed market price to analyze whether the option is fairly priced. This study also considers important factors that affect option pricing through parameter estimation. For the data selection, we choose the FBMK-LCI put option, OKLIP is 1800. This option expires in September 2026. So it satisfies the assignment requirement because the maturity is beyond June 2026. The strike price is 1800 and the market settlement price is 107.70. Since the bid and ask price were unavailable, Bursa Malaysia's official settlement price was used as the market price proxy. Next, for the estimated input parameters, the underlying index price is 1708.50. The time to maturity is 0.350685 years. The risk-free rate is 2.88%, the dividend yield is 2.26%, and the historical volatility is 9.38%. This data were collected from Bursa Malaysia Derivative, Investing.com, and FBMT ETF.
Next, we perform the theoretical valuation of the selected FBMK-LCI put option using the Black-Scholes model. Using the parameters obtained from section 1, namely the underlying index value of 1708.50, strike price of 1,800, risk-free rate of 2.88%, dividend yield of 2.26%, volatility of 9.38%, and time to maturity of 0.3507 years, we first calculated the Black-Scholes parameter D1 and D2. The calculated values were D1 equals to negative 0.8725 and D2 equals to negative 0.9281. Using these values, we obtain the corresponding cumulative normal distribution values and substitute them into the Black-Scholes put pricing formula. The theoretical put options value were calculated to be 96.58, while the observed market settlement prices from Bursa Malaysia was 107.70. This gives a difference of approximately 11.12 index points or 11.51%. Since the market price is higher than the Black-Scholes theoretical value, the option is trading at a premium relative to the model estimate. The difference may be due to changing market volatility, investors' expectation, liquidity effects, and the simplified assumptions of the Black-Scholes model.
To further validate our pricing results, we perform the put-call parity analysis, which represents a fundamental no-arbitrage relationship. Using the formula on screen and the Bursa Malaysia market put price, we calculate the parity implied call price. This implied call value is 20.8, while the theoretical Black-Scholes call is 9.69, resulting in a distinct difference of negative 11.12 points. So this variance perfectly mirrors the market put premium observed in section 2.1, confirming absolute internal consistency under no arbitrage principles. So this discrepancy is driven by real-world market frictions, liquidity effects, and settlement usage. While Black-Scholes relies on historical volatility, the market prices options based on forward-looking implied volatility, causing a systematic divergence. Overall, this analysis provides additional structural validation, confirming the integrity of a theoretical valuation framework.
So hi everyone, I'm Padma and my metric number is 23006204. So I will be presenting for part 3, which is implied volatility and also price simulation. So implied volatility is the volatility the market is expecting in the future based on the current stock price. So using our input such as strike price, our risk-free rate, our dividend yield, time to maturity, and also our market settlement price of 107.7, we reverse the Black-Scholes to solve for our implied volatility. So the result that we will get is 13.001%. Plugging it back, it gives a theoretical price of 107.698. Just to 0.002 away from the market price. So as such, our implied volatility is confirmed. Our implied volatility, now we will be comparing our implied volatility of 13% with the historical volatility of 9.38%. So if you see there is a gap of 4%, we call this gap as a volatility risk premium. Okay, this gap exists because investors worried about the market falling, so they rush into buying the put option as a protection to hedge their risk of going downwards, like buying an insurance for their portfolio. So this heavy demand pushes the price up, and since Black-Scholes works backward from the past price to find the volatility, a higher price naturally gives a higher implied volatility. So to simply put, the market is more fearful about the future than the past data suggests.
Moving on to section 3.3, price simulation, we used our derived implied volatility to simulate the future price pathways for the index at maturity. Applying a 95% confidence interval, using log normal bound, we can see that the index future price sits in between the lower bound of 1,439.23 and an upper bound of 1,946.21. The central is expected to sit at 1,673.63. What's highly critical to note here is that our expected future spot price sits below our strike price, which is 1,800. Because this is a put option, this structural layout statistically indicates a high probability that the contract will expire in the money, capturing significant intrinsic value for the holder. Finally, let's explore our advanced topic, which is the time-varying volatility. The classical Black-Scholes model relies heavily on flawed assumption that volatility remains perfectly constant over time. To test this limitation against reality, we calculated the historical volatility of our index across 3 separate look-back horizons. As you can see from the chart, the past month has been exceptionally calm at 7.52%. However, expanding out to a 3-month window reveals a sharp regime spike to 11.48% due to localized market turbulence, which ultimately in the end stabilizes to a full-year baseline of 9.38%. This variance clearly proves that real-world market risk clusters and change dynamically across different time regimes. Relying on a single static one-year historical figure completely blinds the model to short-term spikes, causing severe mispricing in high volatility markets.
Next, we are going to talk about the sensitivity analysis of FBM-KLCI put option. The Black Scholes parameter D1, D2 and their probability values were first calculated, as they are required for determining all option Greeks in the sensitivity analysis. Next, we are going to talk about each analysis sensitivity. First, delta measures the sensitivity of the put option to movement in the FBM-KLCI index. The delta value of negative 0.8022 indicates that a 1-point increase in the index would reduce the option value by approximately 0.8022 points. Next, gamma measures the rate of change of delta, and the low gamma value of 0.002851 suggests that the option's price sensitivity remains relatively stable for small index. Next is theta put and vega put. Theta measures the effect of time decay on the option value. The daily theta value of 0.0694 indicates that the option gradually loses value as it approaches expiration. Vega measures sensitivity to volatility, and the Vega value of 2.7367 shows that a 1% increase in market volatility would increase the option value by approximately 2.74 points, reflecting the benefits of higher market uncertainty for put options.
Rho is the sensitivity of option price to the risk-free rate, while psi is to the dividend yield. As we can see, for 1% rise in the risk-free rate, it will decrease the option's value, while for psi, there is a positive correlation between the option value and the dividend. Next is volatility skew. We compare implied volatility for different strike price for the put options. So our historical estimate is 9.38%, but the market data shows an upward skew, where the implied volatility rise from 9.11% to 13% as strike price increase. The upward skew contradicts the typical downside skew often seen in global markets. This suggests that investors are pricing in higher uncertainty as index move to 1800 level. It has an impact on Vega. As index move higher, rising implied volatility act as volatility boost that help our put option to retain more value. Hence, the BS assumptions of constant volatility is insufficient to predict the true risk profile of FBM KLCI.